Okay, then all the formulas of level 1 FRA. There are no formulas in study session 7, so we start with study session 8. First topic, income statement. First formula is for straight line method of depreciation. Straight line method of depreciation we can calculate by the value of the asset or price of that asset at which we have acquired that asset minus the estimated salvage value divided by expected life of the asset. Okay, so for example, you have an asset of 1 lakh, expected salvage value 20,000, and the life of the asset is 4 years, then the depreciation every year is going to be 20,000. Straightforward. Next method of depreciation is double declining balance. The formula for double declining balance is opening book value. Okay, now this is not the acquisition cost. Opening book value means the acquisition cost, that means the price at that you purchased, acquisition cost, minus the accumulated depreciation, whatever amount of depreciation that has been charged so far, divided by total life of the asset, not remaining useful life, multiplied with 2. So how do we use this? Let us say there is an asset which was acquired at a price of 100,000. Salvage value which is expected out of this is 20,000 and the life is 4 years. One thing that you would remember is that while calculating the amount of double declining balance, we are not going to consider salvage value at the beginning. So first year depreciation would be 100,000 divided by 4 into 2. So amount of depreciation first year is going to be how much? 50,000. Next year, since you've charged depreciation of 50,000, opening book value would only be 50,000. Divided by 4 into 2, that would give us a depreciation of 25,000. So we have charged total depreciation of 75 so far. Salvage is 80. So remaining 5 we can just depreciate on a straight line basis. So third year we will have a depreciation of 2,500. Fourth year we can have a depreciation of 2,500, so that we reach a salvage value of 20,000 at the end of year 4. Next formula is basic EPS. Basic EPS, the numerator is profit available for equity shareholder, which is calculated as PAT minus preference dividend divided by weighted average number of common shares outstanding during the year. Profit available for equity shareholder divided by weighted average number of common shares outstanding during the year. Now typically on the numerator you need to be careful that if the preference shares are issued during the year, then only half of the preference dividend is going to be charged. In the same fashion, if some of the shares are being issued for less than a year, then we will have to take a weighted average. For example, on 1st of Jan we have 1 lakh shares and 1st of July we have issued additional 2 lakh. Then the weighted average number of shares is going to be this number into 12 by 12 and this number into 6 by 12. So this would be 1, this would be 1. Weighted average number is going to be 2. If there is a stock split or there is a bonus issue, then we have learned that we will simply calculate a multiplication factor. And we will assume that split or bonus was done at the beginning of the year. For example, on 1st of January, we have 5 lakh shares outstanding. On 1st of April, or let's say 1st of July, we've issued additional 10 lakhs. On 1st of October, we've given a bonus share. 2 shares are given bonus for every 3 shares. We want to calculate the denominator of basic EPS formula. So we will say 1st of Jan, this is 1st of July, number of shares 5, number of shares 10. 1st of Jan are outstanding for 12 months, so into 12 divided by 12. 1st of July outstanding for 6 months, so into 6 divided by 12. And then using this bonus, we are just going to calculate a multiplication factor. And in this case, 2 shares given for 3 shares. That means every block of 3 shares is now going to become 5, and therefore multiplication factor would be 5 by 3, and this is your denominator. Just put this into the formula and get your number. Next formula is diluted EPS. Diluted EPS can happen on account of 4 fronts. First one, convertible debentures or convertible bonds. Second, convertible preference shares. Third, employee stock option plan. Or fourth, share warrants. In case of convertible bonds or convertible debentures, the trick with diluted EPS is to start with the formula basic EPS. So which is PAT minus preference dividend divided by number of shares. And then make one adjustment to the numerator, one adjustment to the denominator. In case of convertible bond, since the bonds would be converted into equity share, denominator will increase by those additional number of shares. And numerator, since we've converted those bonds, we don't have to pay interest anymore. However, we will end up paying more taxes. So we will have to add after tax interest in the numerator. This is the adjustment for convertible bonds. In case of convertible preference shares, that number of shares that are going to increase would be added to denominator, and we don't have to reduce or deduct that preference dividend anymore. In case of ESOP, we just have to add, so this is PAT, this is number of shares, some number X to the denominator to calculate diluted EPS, and that number of shares to be added, which we are referring to as X, could be calculated as X is equal to the benefit to the employee divided by average market price into total number of shares issued. For example, let us say profit after tax is 20,000. Number of common shares issued, let's say, is 1,000. Number of ESOPs issued is 1,000. Average market price of these ESOPs or these shares of the company is 100. And the exercise price, the shares at which these shares can be bought by the employees, let us say, is 30. Then we can start with the basic EPS formula, which is profit after tax 20,000 divided by number of common shares 1,000, and to the denominator we have to add one number X. This number we are going to calculate using following formula, that what is the benefit to the employee. 100 rupee share he can buy for 30, so benefit is 70. As a ratio to average market price, 100 into number of ESOPs, which is 1,000, and that would be 700. So your diluted EPS would be 20,000 divided by 1700, whatever is the number. And of course this method is called treasury stock method. Next one, gross profit margin, straightforward. Gross profit divided by sales. Net profit margin, net profit divided by sales or revenue. Next topic now, different classification of investment securities, though strictly not a formula, but we can quickly go through it once. That investment securities we can classify into 3 categories. Either they can be classified as held to maturity, or they can be classified as available for sale, or they can be classified as trading security. On balance sheet, held to maturity would always be shown at amortized cost. The available for sale securities would always be shown at fair value, and trading securities will always be shown at fair value. On income statement, in case of HTM, we will show only the realized gain. In case of AFS, we will show only the realized gain. In case of trading security, we will show realized plus unrealized gain. And on other comprehensive income, in HTM we show nothing. In AFS we show unrealized gain, and in trading securities again we show nothing. Current ratio. Current ratio is straightforward. It's a liquidity ratio. Current assets divided by current liabilities. Quick ratio. It's kind of a more conservative liquidity ratio, where your numerator is cash plus marketable securities plus accounts receivable divided by current liability. What we have not added to the numerator is inventory, And the intuition behind this is that inventory takes the maximum time to get converted to cash. So we want to be more conservative, so we are not going to add inventory. And then the cash ratio, where we are not even going to add accounts receivable. So we will simply have cash plus marketable securities divided by current liabilities. Next one is financial leverage. How do we calculate this? Financial leverage is total assets divided by equity. And higher the ratio, higher is the leverage and more riskier is the company. Next topic, understanding cash flow statement. Formulas related to inventory, accounts receivable, accounts payable and outstanding rent. These formulas we can understand using some simple flowcharts. So different flowcharts for each of the account. For inventory we will say opening inventory, which will increase by the amount of purchase. And then during the year you have some amount of inventory which is X, which can be used for two purposes. Either it could be sold to the customer, which is called COGS, or it could be kept in the closing stock. So now we have an equation. Equation is opening inventory plus purchase has to be same as COGS plus closing stock. And these are four values. So if you have any three, you can always calculate the fourth one. In the same fashion, for accounts receivable, opening accounts receivable, which will increase by the amount of credit sales. Accounts receivable increase if we have made some credit sales. So we will assume some hypothetical number X during the year. Now there are two possibilities with this accounts receivable. Either we have received cash, or these are still your closing accounts receivable. That gives us one more equation, opening accounts receivable plus credit sales, which is equal to cash received from the customers plus closing accounts receivable. If we have any three values, we can calculate the fourth one. In the same fashion, we can have one for accounts payable. Opening accounts payable, which will increase by the amount of credit purchase. We will have some amount of accounts payable during the year, which is X. Now there are two things that can happen to it. Either we pay them cash, or they are still closing accounts payable. So again, one more formula, opening accounts payable plus credit purchase is same as cash paid plus closing accounts payable. And this logic we can extend to any of the liability. For example, outstanding rent. So opening amount of outstanding rent that we have not paid during the year, this amount will increase by current rent. Okay, so this is your X amount of liability during the year. Now what will happen? Either we will pay this rent in cash, or it would become closing amount of outstanding rent. So again, one more equation, opening amount of rent plus current rent is equal to rent paid in cash plus closing amount of outstanding rent. And then again, on any of the current liability, this logic can be applied. Now, formulas related to fixed assets for calculation of cash flow statement. So again, either we are dealing with the gross blocks or we are dealing with the net blocks. Let's say a hypothetical scenario that we have gross block and net block calculation. This is year 1, year 2, year 3 and year 4. Let us say gross block is 100, 100, 150 and 250. Now, the very fact that there is an increase in gross block means that there has been a purchase of new asset, because gross block shows the value of assets at the acquisition cost minus the accumulated depreciation. So let's say accumulated depreciation 10, 20, 40 and let us say 90. And then what we have is the amount of net block here, which would be 90, 80, 110 and this would be 160. Now if you want to find out what is the new amount of asset acquired in this particular year, that new amount of asset would be the increase in gross block, in this case which is 0. I'm assuming that there are no sales made during the year. What is the new amount acquired in year 3? That would be 50 and this is your negative cash flow from investments. New amount acquired in year 4, that would be 100. What is the depreciation expense for year 1? Year 1 depreciation expense is 10. What is the depreciation expense for year 2? It's the increase in this amount, which is 10. Depreciation expense for year 3 would be increase in this amount, which would be 20, and depreciation expense in this year is going to be 50. So the amount by which your accumulated depreciation increases, that's your depreciation expense for that particular year. What is the pro forma for indirect method of cash flow statement? So we would typically start with net income, to which we would add back non-cash charges. We will reduce if there is any non-cash income, though generally not very common. Then we will say plus or minus those items that we have charged to P&L or income statement, but the ones that do not belong to income statement. Sorry, the ones that do not belong to CFO. Do not belong to CFO. So we make adjustment for those items, and what we get here is cash flow from operations before working capital changes. And once we have cash flow from operations before working capital changes, we make 4 adjustments: plus plus, minus minus. If the current liability increases, we add. If current liability decreases, we subtract. If current asset decreases, we add, and if current asset increases, again we reduce. And what is the way to remember this? That if it's a liability, the relationship is direct, which means whenever the current liability will increase, we will add. Whenever the current liability will decrease, we will reduce or subtract. In case of asset, the relationship is inverse. So whenever current asset decreased, wherever current asset increased, we reduced, and current asset decreased, we added. And then finally, after these 4 adjustments, what you'd get is the cash flow from operations. FCFF, 4 formulas. Either we can have FCFF starting from net income, or starting from CFO, or starting from EBIT, or starting from EBITDA. If you are starting with net income, the trick is to somehow reach to cash flow statement. And then we will say net income plus non-cash charges plus or minus working capital adjustment or working capital investment. These 3 numbers are nothing but cash flow from operations. And once you reach cash flow from operations, then you just make 2 adjustments. Which 2? First, you will have, since you've reduced interest here, you would want to add back interest, but that has to be net of tax. And second, you would want to reduce the investment made into fixed capital. So the same 2 adjustments here: interest 1 minus T and investment made into fixed capital investment. If you're starting with EBIT, you can say EBIT into 1 minus T, and EBIT into 1 minus T is similar to net income plus after tax interest. And once you have these 2 items adjusted in EBIT into 1 minus T, just adjust the remaining ones, plus NCC plus or minus working capital investment minus fixed capital investment. Similar, if you have EBIT, EBITDA, and if you say into 1 minus T, then to this number you would want to add back depreciation into T. And these 2 numbers are similar to EBIT into 1 minus T plus NCC. And once you have that, then simply plus or minus working capital investment and minus fixed capital investment, and again what you have is FCFF. So these are your 4 separate formulas. Once you've been able to calculate FCFF, then you can get FCFE easily directly from that. So from FCFF we have to reduce whatever interest or whatever payment we made to the bondholders, and we can either pay them interest, but of course that we have to adjust for taxes, or we can either repay them the principal. So this is repayment of principal. And then what you directly have is free cash flow to equity. Okay, so FCFF minus interest into 1 minus t minus repayment of principal. If you've taken fresh loan, then we are going to add that, and if you repay the principal, then we are going to minus it, and then you would get FCFE. Next one is cash flow to revenue ratio, straightforward ratio, cash flow from operations divided by the total amount of revenue. And do you want this number to be higher or lower? Higher. Higher the cash flow from operations, better it is. Next one is cash return on assets ratio. Again, this is cash flow from operations divided by average fixed assets. And do you want this number to be higher or lower? Higher again. Next one is cash return on equity ratio. Cash flow from operations divided by average equity. And again, we want this number to be higher. Cash to income ratio. This is calculated cash flow from operations divided by earning before interest and taxes, which is your operating income. And again, higher the ratio, it is considered, better it is. Next one is cash flow earning index. I would recommend you to remember this for your exams. Cash flow earning index is again cash flow from operations divided by net income. And ideally this ratio should be increasing, and if it's more than 1, it's considered as a very good indicator. Cash flow earning index. Next one is cash flow per share. Cash flow per share is cash flow from operations minus the preference dividend divided by average number of common shares outstanding. So I'm simply writing number of shares. Again, this number is used, cash flow per share, for valuation of equity stock using relative valuation methodologies. Next one is debt coverage ratio. This would be cash flow from operations divided by the amount of debt that you have. Again, higher the number, better it is. Next one is interest coverage ratio. There are multiple ways in which this is calculated. The common way in which this is calculated is EBIT divided by interest, or at times it is also calculated as EBITDA divided by interest, or at times it is also calculated as cash flow from operations plus interest, cash flow from operations plus interest divided by interest. And again, the intuition is to find out that what is the earning of the company, is it sufficient enough to cover the interest, and how many times of interest payment do we have the operating profit. Okay. Next one is reinvestment ratio. This is cash flow from operations divided by payment made towards acquisition of long-lived assets. Payment made towards acquisition of long-lived assets. So it's like this. Imagine a scenario that every company acquires new assets worth 200 every year. Now if the cash flow from operations is 600, that means it has been able to generate thrice the amount of cash which is required for reinvestment purpose. So higher the number, better it is. Debt payment ratio. This is calculated as cash flow from operations divided by payment made or amount repaid to long-term lenders, or bondholders. Again, what is the idea? Do we have sufficient cash flow from operations to repay the debt holders or bondholders? Next one is dividend payment ratio. Cash flow from operations divided by the amount of dividend. And next one is investing and financing ratio, which would be cash flow from operations divided by cash flow from financing plus cash flow from investment. And again, the idea is to see that cash flow from operations is what proportion of the other two cash flows. And again, larger the number, better it is.